If you are a small Bitcoin or crypto investor in 2026, this message is for you. Not to scare you, not to create panic, but to prepare you. Because every cycle in crypto creates millionaires. And every cycle also quietly wipes out thousands of small investors who believed this time is different. And history shows us something uncomfortable. The people who suffer the most are usually the late buyers, the emotional traders, the overconfident retail investors who think the bull market will last forever. We have seen this before. In 2017, Bitcoin went nearly parabolic. Retail investors flooded into the market. Everyone was talking about Lambos. By early 2018, the market collapsed more than 80%. In 2021, the excitement returned. Institutional adoption headlines, celebrity endorsements, NFTs exploding, meme coins doing 100x. And then 2022 came. Bitcoin fell over 70% from its all-time high. Many altcoins dropped 80 to 95%. Entire platforms disappeared. Billions in leverage were liquidated. And now we are in 2026. The market feels strong again. Optimism is back. Headlines are bullish. Predictions are bigger than ever. But here is the question no one wants to ask. What if the conditions forming right now are the early signs of another major correction? Let's slow down and understand how crypto cycles actually work. Markets do not move randomly. They move in psychological waves. First comes accumulation. This is when prices are low, sentiment is negative, and only patient investors are buying quietly. Then comes the early bull phase. Smart money increases positions. Confidence slowly returns. After that comes the acceleration phase. Media attention increases. Prices rise faster. New investors enter the market. Then comes euphoria. This is the dangerous phase. Everyone feels like a genius. Social media is full of price targets that sound unrealistic. Leverage increases. Risk management disappears. And finally, distribution begins. Large holders quietly start selling into strength. Liquidity dries up. One unexpected macro event happens. Panic starts. The crash follows. If you are a small investor, you must understand this structure because most retail participants enter during acceleration or euphoria. Very few buy during accumulation, and when prices fall sharply, emotions take control. Fear replaces confidence. Instead of buying low and selling high, many end up buying high and selling low. Now let's talk about 2026 specifically. What are the possible risks that could trigger a serious correction? First, macroeconomics. Crypto does not exist in isolation. Interest rates matter. Global liquidity matters. If central banks tighten policy, reduce money supply, or signal long-term restrictive conditions, risk assets often suffer. Crypto is still considered a high-risk asset class. When liquidity contracts, speculative assets feel pressure first. Second, institutional behavior. In recent cycles, large institutions and ETFs have played a bigger role. ETF inflows can drive massive upward momentum, but outflows can create equally strong downside pressure. Retail investors often react emotionally. Institutions react strategically. If major funds start reducing exposure quietly, the market structure can shift before retail even notices. Third, leverage. Leverage amplifies both gains and losses. For beginners, leverage means borrowing money to increase position size. For example, using 10x leverage means a 10% drop can wipe out your entire position. In bull markets, leverage increases because traders feel invincible. When price reverses, liquidation cascades happen. One liquidation triggers another. That chain reaction accelerates crashes dramatically. Fourth, miner behavior. Bitcoin miners are essential to the network. They secure transactions and receive block rewards. But miners also sell Bitcoin to cover operational costs. After halving events, block rewards decrease by 50%. If price does not increase enough to compensate, weaker miners can experience financial stress. When miners capitulate and sell reserves aggressively, market pressure increases. Fifth, on-chain signals. Experienced investors monitor metrics like exchange inflows, long-term holder supply, realized profits, and network activity. When large amounts of Bitcoin move to exchanges during high euphoria phases, it often indicates potential distribution. When unrealized profit levels reach extreme historical highs, risk increases.
Sixth, market psychology. When everyone on social media predicts $250,000 Bitcoin in a straight line, when meme coins without fundamentals are outperforming real utility projects, when taxi drivers and distant relatives are giving crypto tips again, that is not necessarily strength. That is often late cycle behavior.
Let's also simplify some important concepts for newer investors. Liquidity is the ease with which assets can be bought or sold without causing large price changes. When liquidity is high, markets feel stable. When liquidity dries up, price swings become violent. Bitcoin dominance refers to Bitcoin's percentage of the total crypto market cap. When dominance rises, capital often flows from altcoins back into Bitcoin. When dominance falls sharply during hype phases, it can signal excessive risk-taking in smaller assets. Market cycles are natural expansions and contractions driven by human emotion and capital flow. No market goes up forever. No market stays down forever. The key is recognizing where we are within the cycle. Now, this is not a prediction that a crash will happen. It is a warning that risk increases when optimism becomes extreme. A crash does not require catastrophic news. Sometimes it only requires exhaustion. Buyers run out. Sellers increase. Momentum shifts. So what can small investors do differently? First, risk management. Never invest money you cannot afford to lose. Crypto volatility can reach 20 to 30% moves within days. If your financial stability depends on short-term price movement, you are exposed to emotional decision-making. Second, portfolio structure. Instead of going all in on speculative altcoins, many disciplined investors allocate across different risk tiers. For example, a conservative educational model might include a large portion in Bitcoin, a moderate allocation to established large-cap projects, and a smaller allocation to high-risk emerging tokens. The key principle is balance. Third, avoid excessive leverage. Leverage is not evil, but it is dangerous without strict discipline. Most retail traders lose money with leverage because they underestimate volatility. Fourth, build a cash reserve. Having stable liquidity during crashes allows you to buy when others panic. The investors who build wealth across cycles are often the ones who prepare during euphoria. Fifth, think long-term. Short-term price movements are unpredictable. Long-term adoption trends are more stable. Blockchain technology continues to evolve. Institutional infrastructure continues to develop. But price will not move in a straight line upward. We also need to discuss regulatory shifts. Governments worldwide are refining crypto policies. New frameworks can either boost institutional confidence or temporarily shock markets. Sudden regulation headlines can trigger rapid volatility. Another overlooked factor is correlation with traditional markets. In previous years, Bitcoin has shown periods of strong correlation with stock indices, especially tech stocks. If global equities experience correction due to recession fears or geopolitical instability, crypto may not be immune. Experienced miners and investors also monitor hash rate trends. A sudden drop in network hash rate can signal miner stress. Rising hash rate during bullish price action often reflects confidence and network expansion. In 2026, one of the biggest risks may not be a single event. It may be overconfidence. When narratives dominate logic, when influencers promise guaranteed outcomes, when risk is ignored because institutions are here now, complacency builds. Remember, institutions are not emotional. They hedge, they manage risk, they exit positions strategically. Retail investors often do the opposite. So if you are watching this as a small investor, here is the mindset shift. Instead of asking, how high can it go? Start asking, what could go wrong? Not from fear, from preparation. Imagine two investors. Both enter during a strong bull market. One invests everything, uses leverage, and believes price will never correct more than 10%. The other invests gradually, keeps reserves, avoids leverage, and plans for a 30 to 50% correction scenario. When volatility hits, who survives? Who has capital to deploy? Who sleeps at night? The goal is not to perfectly time the top. That is nearly impossible. The goal is to manage risk so that even if a correction happens, you remain in the game. Crypto rewards patience more than speed. It punishes arrogance more than ignorance. A potential 2026 correction would not mean crypto is dead. Every major crash in history was followed by innovation, rebuilding, and new all-time highs years later. But the investors who benefited were the ones who survived the downturn. This is about probability, not certainty. No one can guarantee a crash. No one can guarantee endless upside. But we can observe patterns. We can study history. We can prepare intelligently. The question is not whether volatility will come. Volatility is guaranteed in crypto. The real question is whether you will be prepared when it arrives. Stay rational when others are euphoric. Stay disciplined when others are reckless. Stay patient when others chase. And most importantly, never let emotion control financial decisions. Because in crypto, the biggest gains often come to those who think clearly when everyone else is thinking emotionally. Prepare wisely, invest responsibly, and remember, surviving the cycle is more important than chasing the top.